Brace yourselves, UK. The autumn 24 budget is about to shake things up in a massive way. If you've got shares, you run a business, or you're just earning a paycheck, this budget could hit your wallet hard. With a £40 billion funding gap looming, Chancellor Rachel Reeves faces one of the toughest fiscal challenges in recent history. How will she close the gap though? So, she's ruling out austerity, has said that she'll protect public services, and has promised not to raise income tax, VAT, or national insurance for working people. But hey, let's be real, there's only so much room to manoeuvre. This means we're in for some big tax changes, and today we'll be breaking down the top 5 that are most likely to hit you. So first, let's talk about capital gains tax, specifically the tax on shares and investments. Right now, CGT on shares sits at 20%, but the word on the street is that this is possibly going up to 24%, bringing it in line with CGT on property sales. Former Treasury officials have indicated that this move could help plug some of the funding gap without hitting the property market too hard. So, what does this mean for you? Well, if you've got investments in stocks, you could be seeing a higher tax bill when you come to sell them. This may also push investors to reconsider selling or reshuffling some of their portfolios before the changes take effect. Now, the good news is that it's not as big jump as people had initially thought. There were rumours that this could climb to around 39%, but even a 4% increase could raise several £1 billion for the Treasury. Still, there is a risk here. If investors start holding off on sales, tax revenues might not raise as much as the government hopes. Second, we've got national insurance contributions. However, it's employers who will bear the brunt of this one. Reeves is eyeing a 2% increase that businesses will have to pay, which could rake in a whopping $18 billion. But here's the catch on this one. While employees won't see this directly, businesses are likely to pass these costs on, either through fewer hires or even smaller wage increases. For workers, this could translate into slower wage growth or even tougher job markets, especially for those sectors already feeling the pinch of inflation. And this is where the real balancing act comes in. Raise too much and businesses might freeze hiring. Raise too little and the funding gap doesn't close. It's a fine line that Reeves will need to tread. Next up is income tax thresholds. So this one's a bit of a stealth move, but it will hit millions of people. The government is expected to extend the freeze on income tax thresholds beyond 2028. This tactic is known as fiscal drag, and it doesn't directly raise your tax rate, but here's the sneaky part. If your wages go up, you might get pulled into a higher tax band, even though nothing changed on paper. This will impact everyday earners. As inflation drives wages up, more people will find themselves paying higher rates of income tax without an increase in their tax-free personal allowance. This policy alone could raise an additional $7 billion a year by 2029 to 2030. This is money that would have otherwise stayed in your pocket. So, whilst Reeves sticks to her pledge not to raise income tax rates, more of us will find ourselves handing over a bigger slice of our earnings as time goes on. Up next is inheritance tax, a topic that makes a lot of people sit up and listen. Reeves is expected to target some loopholes in the current system, particularly those that help wealthier families to pass down their assets with lower tax bills. So, while this move won't overhaul the entire system, for those of you who have substantial estates, it's time to check how these changes might affect your long-term financial planning. Small changes here could mean a bigger tax bill for those passing down large amounts of wealth. Now finally, here's a good bit of news. For property owners this is. Despite speculation, there likely won't be any changes to capital gain tax on property sales. After the former Chancellor Jeremy Hunt reduced CGT on property down to 24%, it looks like Reeves won't reverse that. This means that those selling second homes won't face a heavier tax burden, at least for now, as the 24% looks like it's hit a sweet spot. It's been able to raise revenue without stifling transactions in the housing market. For anyone planning to sell properties soon, this stability in CGT is welcome relief. But unfortunately, that's not all. Other tax changes could potentially hit the table, with Reeves under pressure to go after non-doms, private equity executives, and potentially extend the freeze on personal tax thresholds even further. So, though none of these are set in stone, keep your eye on inheritance tax tweaks and possibly new levies for high earners. What have we learnt in this video? First, capital gains tax on shares is likely rising. Employer NI could cost businesses more and employees could feel the pinch too. The income tax threshold freeze means that more of us could be dragged into higher tax brackets. Inheritance tax loopholes are being tightened. And for now, CGT on property sales stays steady. With a £40 billion funding gap to fill, the autumn 24 budget could be felt across the board. Whether you're looking at investing, working, or just simply trying to manage your estate, these changes will impact you. Planning ahead is key. Make sure you speak to your accountant or financial advisor before these changes take effect. If you'd like more information on 10 other likely changes, watch this video here.